Welcome to SS2 Commerce. Today we study monetary policy in Nigeria, the actions taken by the Central Bank of Nigeria to manage money supply and interest rates in order to achieve macroeconomic objectives. Monetary policy affects everything from the cost of borrowing to the exchange rate of the naira to inflation and employment. Monetary policy refers to the deliberate control of money supply and credit by the central bank to achieve macroeconomic objectives such as price stability, low and stable inflation, exchange rate stability, full employment, economic growth, sound and stable financial system. In Nigeria, the CBN, or Central Bank of Nigeria, is responsible for monetary policy. The Monetary Policy Committee, MPC, which meets every 2 months, makes monetary policy decisions. Monetary policy can be expansionary or contractionary. Expansionary, loose, monetary policy. Goal: stimulate economic growth and reduce unemployment. Method: reduce monetary policy rate (MPR), reduce cash reserve ratio (CR) by government securities (OMO). Effect: banks can lend more, interest rates fall, businesses borrow and invest, spending and employment rise. Risk: can cause inflation if money supply grows too fast. Contractionary, tight, monetary policy. Goal: reduce inflation and cool an overheating economy. Method: increase MPR, increase CR, sell government securities. Effect: banks lend less, interest rates rise, borrowing falls, spending and inflation fall. Risk: can slow economic growth and increase unemployment. The CBN uses several instruments to implement monetary policy. 1. Monetary policy rate, MPR. The MPR is the benchmark interest rate at which the CBN lends to commercial banks. When the CBN raises the MPR, commercial banks charge higher interest on loans to businesses and individuals, reducing borrowing and spending. When the CBN lowers the MPR, borrowing becomes cheaper, stimulating economic activity. The CBN raised the MPR significantly in 2023 to 2024 to fight high inflation, reaching 27.25% by May 2024. 2. Cash reserve ratio, CRR. The CRR is the minimum percentage of a commercial bank total deposits that must be kept with the CBN as reserve. It is not available for lending. If the CRR is 30% and a bank has deposits of 100 billion naira, it must keep 30 billion at the CBN and can only lend out 70 billion. A higher CRR reduces the amount banks can lend, reduces money supply. A lower CRR allows banks to lend more. Nigeria's CRR has been as high as 45% in recent years. 3. Open market operations, OMO. Open market operations involve the CBN buying and selling government securities, treasury bills, FGN bonds, in the money market. When CBN sells securities, commercial banks and the public use money to buy the securities, money flows out of the economy, money supply falls, interest rates rise. When CBN buys securities, CBN pays money to the holders, money flows into the economy, money supply increases, interest rates fall. OMO is a flexible and frequently used tool. 4. Liquidity ratio. The liquidity ratio requires banks to maintain a minimum percentage of their total assets in liquid form, cash and assets easily convertible to cash. Increasing the liquidity ratio restricts banks' lending capacity. In Nigeria it is typically set around 30%. 5. Special deposits. The CBN can require banks to deposit a special percentage of their deposits at the CBN at zero interest as a way of reducing the money available for lending. This is an additional tool beyond the standard CRR. 6. Moral suasion. Moral suasion involves the CBN using its authority and persuasion, meetings, guidance, public statements, to influence commercial bank behavior without formal legal instruments. For example, the CBN may call bank CEOs and warn them against excessive foreign exchange speculation. The quantity theory of money states, MV equals PQ, where M equals money supply, V equals velocity of money, how fast money changes hands, P equals price level, inflation, Q equals real output. If money supply, M, grows faster than real output, Q, while velocity, V, stays constant, prices, P, rise, this is demand pull inflation. The CBN uses monetary policy to prevent money supply from growing too fast. Nigeria has experienced high inflation in recent years. Inflation rate hit 33.95% in May 2024, highest in nearly 30 years. Driven by Naira depreciation, imported inflation, fuel subsidy removal, cost push, insecurity in food-producing areas, money supply growth. CBN response, aggressive MPR hikes from 11.5%, 2022, to 27.25%, 2024. Monetary policy in Nigeria faces several challenges. 1. Structural inflation. Most inflation in Nigeria is cost push, food, energy, imported goods, not easily controlled by interest rate hikes. 2. Fiscal dominance. When government spending is very high, deficit financing, it can undermine monetary tightening. 3. Large informal economy. Many transactions in Nigeria are cash-based and outside the formal financial system, making monetary policy less effective. 4. Underdeveloped financial markets. Weak bond market limits OMO effectiveness. 5. External shocks. Global oil price changes dramatically affect Nigeria economy regardless of domestic monetary policy. Key distinction. Monetary policy, managed by the CBN, controls money supply, interest rates, credit. Fiscal policy, managed by the Ministry of Finance/Federal Government, controls government spending and taxation. Both are macroeconomic stabilization tools. Ideally, they work together. In Nigeria, coordination between CBN monetary policy and Ministry of Finance fiscal policy has been challenging, especially when government runs large budget deficits. Summary of monetary policy in Nigeria. Monetary policy, CBN control of money supply and interest rates to achieve price stability, full employment, economic growth. Expansionary policy, reduce MPR, reduce CR, buy securities, stimulates growth, risks inflation. Contractionary policy, raise MPR, raise CR, sell securities, reduces inflation, risks recession. CBN instruments, MPR, CR, open market operations, OMO, liquidity ratio, moral suasion. Nigeria 2024, MPR raised to 27.25%, inflation at 33.95%, May 2024. Challenges, structural inflation, fiscal dominance, large informal sector. Monetary policy versus fiscal policy, CBN versus Ministry of Finance.